just a matter of time the whole thing implodes. I think it's a broken market. I fully expect it's going to head towards 10,000. I think we're going to get a 10% down here, at least. Will be the biggest, most significant ebbing tide factor ever. Never seen what's happening in the precious metals, what's happened this year. Never seen it.
It's Monday, the 9th of February, and the S&P is back up to almost 7,000 points. Gold is back up above $5,000. Silver rose as well, and Bitcoin has risen from its lows last Friday, and now it's up to 70,000. Is this the beginning of a rebound? We'll talk about that with Mike McGlone, Senior Commodity Strategist at Bloomberg Intelligence. Welcome back to the show. Good to see you, Mike.
Oh, thank you, David. Thanks for having me back.
The 10-year yield moved higher today. Investors are busy waiting for economic data this week. Japanese stocks are up. Speaking of the economy, layoffs in January were the highest to start a year since 2009. And so we've got a mix of challenging economic data on the back of what may be a more dovish Fed. We'll find out if Kevin Warsh is indeed a more dovish Fed chair. And Bitcoin is stabilizing around 70,000, and gold and silver. Silver had its worst single-day drop since 1980, actually, a week and a half ago. But things look like they're stabilizing. Are they stabilizing, Mike? Where are we headed next?
And as far as gold and silver, David, they look to me like cryptos did last year. I think the high price cure is kicking in. The rule of Adam Smith and the invisible hand will kick in. Silver, I think, is much more likely to head to 50 than stay above 100. Gold, I think, is more likely to head to 4,000, stay above 5,000. Everybody gets the fundamentals. But markets go up too much, you shift all those fundamentals, you shift that supply-demand curve, bring on some more supply, reduce demand. The word we should be hearing in silver by this time next year is thrifting, and supply can come on from underwear drawers, but either way, it always does. And so I look at the way I view it right now, things like gold is about 2 times its 60-month average, about 60% above a 200 or 100-week moving average. That's the most since 1979 and 80. And the way I look at it is it'll be different this year. We'll look back upon 2026 as different if gold does not and silver do not put in multi-year peaks, and if stock market volatility does not recover. So I have to tilt over to that a little bit, because that's kind of the essence for everything. My main base case for this year is we still have stock market volatility. As you mentioned, S&P 500 is pushing on 7,000. 180-day volatility, S&P 500 is running at 8-year lows. Simple observation and simple outlook. I think it's going to go up this year.
Which do you think will do better this year, gold, Bitcoin, silver, or stocks?
Bonds. I think by the end of this year, we're going to see down years for silver. I think silver's more likely to head to 50. Very high probability kicking towards gold to being a down year. Now, that's much more against consensus because it's with momentum, but it's just acknowledging the issues. The key thing about the stock market is it's completely priced in. Just the concept of not having another 10% up year in beta this year is anathema. And so I think we're going to get a 10% down year, at least. And that's the key thing I just wrote about recently on X. I think the next 10% drawdown, which at some point will come, will be the biggest, most significant ebbing tide factor ever. So I think, look at things like Bitcoin had that peak near 100. I think it's much likely to head much lower if stock market goes down. You look at copper. It's tried to get above 6, didn't really do so well. It's rubbing around just below it right now. I think it drops right down towards 5 if the stock market goes down. Even crude oil. Crude oil is being held up by the potential of this armada surrounding Iran doing something, but it's an oversupplied market. Now it's allowing those oversupplied entities to bring on more supply. So I think that inordinate burden I've been talking about forever is the most extreme in history. And we're way overdue for what happened to cryptos. Cryptos got trumped. I think stocks are next to get trumped.
I guess thesis of this chart here that we're looking at on the screen, Bitcoin reversion, my guide to risk assets. You published this report and this chart on the 6th of February, so last Friday. And since then, Bitcoin has rebounded back to 70,000. So do you still hold the view that stocks will retrace down following Bitcoin's move last week?
At some point, well, it's not just the move last week. Bitcoin peaked in October.
Sure.
So the NASDAQ hasn't taken out that high yet. I think we're kind of in this silly stage where Bitcoin's in a clear bear market, but we're still at the stage where most people are denying it. I think it's a broken market. I fully expect it's going to head towards 10,000. And I did point on that chart, the mode from 2024 was 64,000 or approximately. So far, if it's held, that is a support level. It's supposed to hold. It's supposed to bounce. A typical 20% bounce is up to 72, maybe even 74,000. But that's what happens in bear markets. To start a new bull market now, I think is very unlikely. The key themes for a new bull market is typically you have to have lower prices, and I can define that with other technical measures. And you almost always have to have the stock market going up, but and volatility going down. But volatility's already gone down, and stock market's already gone up. See the problem?
Yeah.
Bitcoin's basically failed every test. It's failed its test against beta. It's not leveraged beta anymore. It's just underperforming high volatility beta. It was. It's not leveraged gold anymore. It's way underperforming gold. So to me, the thing is, I like to point out there was one cryptocurrency in 2009. Now there's 33 million based on CoinMarketCap.com. The rally and all those risk assets led the risk assets higher. I think they're just leading the way lower. And I add to that this parabolic move we've had in gold and silver. We have not had gold grab alpha like this in about 50 years. And when gold grabs alpha, I stand worried. I mentioned that last year. I still stick with that. And I think the next big trade is going to be just this U.S. 30-year long bond. It keeps bumping up against 5%, yet it doesn't get through. It can't get through. I think it's unlikely to get through. And what's the vested interest of Mr. Trump as we head towards the midterms? He wants those yields to go lower, interest rates to go lower, which probably means that long bond price going up from 115 in the futures, and energy prices going lower.
Fundamentally, why does Bitcoin lead the stock market?
It's a highly leveraged speculative risk asset, and it makes sense it would because it did. It was launched at the depths of the great financial crisis in 2009. And it led the way up. The problem is what Trump 1.0 and what Satoshi Nakamoto missed were the proliferation of stablecoins. The most enduring bull market in all of cryptos is, people call them stablecoins. I call them crypto dollars. From Tether was about 2 billion in 2018. Now it's 184 billion. And the next most significant crypto is Ethereum. I think it's just a matter of time that Tether flippins Ethereum. It's been doing that to every single one of them, but it's because it's the whole space is the tip of the iceberg of speculation. That's cryptos, and they're getting purged. And I think it's just a matter of time we have to complete that purge. So I just mentioned Tether accumulating higher, and just look at things like Dogecoin. Launched as a joke. It is a joke. It's worth $15 billion. It's peaked with $60 billion. I think it's a matter of time it drops to zero. Now, once you get through the purge of the silliness, then we might have a workable bottom. But for now, I think it's completely dependent on the stock market going up, and we're way overdue for stock market volatility to do what it always does. It mean reverts. And 180-day volatility, 10-year average is around 17 or 18%. Right now, it's 11%. It's just a silly stage to be thinking about way over allocating risk assets, and the riskiest are cryptos.
Before we continue with the video, let's talk about today's sponsor, Monetary Metals. With gold prices having hit all-time highs, we know why people hold gold. It's because it's real money. But what if your gold could do a lot more than just sit in a vault? Well, that's where Monetary Metals comes in. They offer a way for you to earn a yield on your gold paid in physical gold. Through their leasing marketplace, you can earn up to 4% yield per year in gold. That means instead of storing your gold in a vault and letting it sit idle, you can lease it out to vetted businesses in the gold industry and get paid in more gold. Thousands of investors are already earning a monthly yield in gold and silver through Monetary Metals, so scan the QR code here or go to monetary-metals.com/Lin. Link in the description down below to learn more. Don't just hold gold, put it to work. Let's just talk about this paragraph in your report. Gold could stretch to $6,000 an ounce in 2026, but the 55.95 high as of February 3rd has inklings of 2011's 1,921 peak, with a notable difference, the extended stock market. Why is the stock market posing a differentiating factor here?
Power the margin call. The thing now is, one thing that's really been a good premier indicator for me was that the ratio of S&P 500 in terms of ounces of gold. Right now, it's 1.38 ounces of gold per one S&P 500. I think it's going to one. Just at the start of last year, it was about one, closer to 2.3. So that's broken down hard. The problem is gold is just way too expensive now. Relative to itself, sure, 60-month moving average. It's just one of those lessons what you learn in trading when you've been on top of a trade and it does very well and it breaks out. You don't double down on it. You lighten up, and particularly when it's just getting kind of silly. I think it's certainly silver. Silver was 2 weeks ago was the most expensive ever versus crude oil and copper. Copper is its electronic, conducting brevin in the metals. And so I view the whole space as just the simple thing is I switch over, David, to a risk manager. When prices go up this much, I have to point out that it'll shift all those narratives that people are using to buy it. It's a speculative frenzy, and it typically almost always goes back down. That's what happened to crude oil when it was 100. There's good reasons for that. That's what happened to corn when it was above 8. And I'll end with this. The two worst performing commodities last year were orange juice and cocoa. They were the best performing commodities in 2024. That's the thing to remember is the pendulum always swings. And I think crypto's obviously swinging back down. And the biggest pendulum on the planet is the U.S. stock market. And when that starts reverting, which I didn't say if, it'll be a matter of time, the signals I'm getting from parabolic rallies in precious metals and declining cryptos are just frightening for what it means for a normal little correction in the stock market. So to me, that's the bottom line now. Is if you're bullish copper, you have to expect that stock market to keep going up. But 10% correction probably means copper drops 20%.
Speaking of the metals and stocks, do you think the same macro forces that drove gold and stocks together in the same direction, meaning making them move in tandem, do you think those same macro forces will still be in play in 2026?
I think what we're going to kick into by the end of 26 is normal deflation from inflation. And gold is already inflated way too much. It's too expensive. The stock market is the main source now. Even my colleague Anna Wong mentioned that in our morning meeting. That wealth effect is the key thing that's driving retail sales and driving consumption. And we're way overdue for some reverse wealth effect. We're certainly getting that cryptos. So my point is, when we get the normal correction in the stock market, it's going to be to sell everything except for one thing that's deflationary, and that's probably Treasury bonds. But that's my point is we had awesome alpha from Bitcoin for many years, particularly really kicking in 2019 when it got down around 5,000, actually 3,000, but kicking in there. And then when Michael Saylor jumped on board in 2020 when it was around 10,000, 10x, that's great. But now, and then it switched over to gold. Gold was the alpha, but now gold's always extreme. So to me, the only key thing left to get alpha and beta stock market is good old normal reversion in stocks, which means T-bonds go from 5% to 3%, and they're still above the yields in China, and that's a bad thing to remember. We're still having those pretty severe deflationary forces in China. If you look at their 10-year note yield at 1.81%. Now, viewers have heard me say this before. It's very rare for copper and iron ore and crude oil to go up in an environment when China is deflating, so that's why I'm worried that we might just roll over a little bit in 2026, will we look back upon as a post-inflation deflationary year.
Can you just explain something for us, Mike? Copper, silver, this is silver, so it's now back down towards 82. But if you take a look at how the metals have moved together, this is something that I've been asking people for an explanation, and it stumbled some people here now, Mike. I'm going to put in a bunch of things. So palladium, silver, I've got on the swing copper, palladium, gold, silver, and I'll add platinum as well. And you can notice now, Mike, these metals have different industrial properties and usages, and they're mined from different places, but they all moved at exactly the same times in the last week and a half. Why?
Let's first start with the first potential demand source on the planet, China. And also let's remember what's happening with the macro. The war was, started almost exactly with the Winter Olympics 2022, Russia's invasion of Ukraine, the unlimited friendship, which really tilted everything towards gold, in my view. But also, remember, it took until I kept calling for gold to break above 2,000, then 2022 and 2023, called for it. It didn't break above 2,000 until 2024. So it's a scramble for all the metals. Now, the China is certainly stockpiling crude oil. I suspect they're stockpiling some of the other metals. I know the people are. I was on with the call on Hong Kong last week, and boy, were they enthusiastic for all these ETFs. I said, yeah, this looks like all enthusiasm for Bitcoin ETFs and crypto ETFs a year ago. So what you're seeing there is an alternative. And metals, metals are perfect alternative. I look at the precious metals and the metals as a bunch of doves in a world of pigeons when you compare it to cryptocurrencies. They're just gaggles of pigeons of cryptocurrencies, millions of them. There's only two handfuls of really good metals. And the precious metals, gold, silver, platinum, and palladium, have always been some of my favorite long-term holdings because they go up over time and there's good industrial demand and you can hold them easily in ETFs. Poof, that trade has ended, I think, because they went up too much. Palladium did it a few years ago. I've been involved in that forever, but certainly platinum this year gave you signals that cocoa did a year ago when it broke out. But then markets move. We all hear about the fundamentals that drove it, and then they shift. And that's where I thought and still think any moves in silver near 100 is a prudent short. Any near moves in copper near 6 is a prudent short because they're industrial metals and you have to depend on some kind of miracle economic demand pull out of China, despite them facing pushback from the whole world, from them exporting their deflation. And then they're all dependent on the U.S. stock market to keep everything higher. The only one that's the least involved, I think, in the stock market staying higher as an alternative is gold, but now it's too expensive. So I think we might get a situation where they all go down when the stock market goes down. It's just gold will go down the least.
Let's talk about the Fed. Now, Kevin Warsh being nominated as the next Fed chair. First of all, he hasn't been appointed officially yet, but let's assume that he does take the reins. Will he be less hawkish than what some people might have expected as Jerome Powell's successor?
Well, it's a wonderful situation because...
Or more hawkish, rather. More hawkish, less dovish is what I meant, yeah.
It's a wise choice. Most people perceive him as a past hawk. Our economic team said, yeah, he'll probably be going with the Trump mode for now, but we need to ask ourselves, does Mr. Warsh or will Mr. Warsh allow him to go down in history as Trump's lackey, akin to Arthur Burns and President Nixon? And that's what shifted. That's the wonderful thing about the checks and balances in this system. I doubt that. And all the economists and certainly people I know who actually know him said, when there's a whiff of inflation, or if there's a whiff of inflation, he'll be on top of it, and he's not going to let the Fed go down in history as something akin to what's Turkey or even the Fed under Nixon and Burns. So that we're not worried about. I think right now looks like the Traubman shows it was a tremendous choice. And now we have to get through this silliness of the President of the United States pushing back on the Federal Reserve Chairman that he appointed because he won't ease rates, which is why gold loves him. Every time Mr. Trump speaks, gold just smiles. But now we've reached extreme. So I'm not worried about him, but I hear the key thing that's, I think, going to happen next year, David, or not as we kick in, is it's not going to matter. When the U.S. stock market goes down, Fed interest rates will drop really fast. Until that happens, it is silly to drop interest rates, and because it's just what our economists keep saying, is that the wealth effect. And if someone sitting in the Fed is ignoring that, let history judge them accordingly, because it is the economy now. When you're 2.3 times GDP, it is the economy. And we'll see when we drop 10% and stay down, you'll see that the clothes people are wearing clothes. And that's just basically what happened in the crypto market. It dropped. October 10th was the peak. We found out who was wearing clothes. It's just the way it always works. But so I think he's going to end up being a cog in the wheel. And when the stock market starts declining, which will be Trump's stock market, then I think it's going to get Trump like cryptos did. They'll ease, at least fast. And we'll still have deflationary forces like we have had in China and in Japan for most of the last 30 years.
But the fact that you think that the economy might experience more disinflationary forces, that might impede the Fed from actually wanting to cut rates, which may be bad for markets. Would that make sense?
Well, at this stage, when you get this high, what else is good for markets? We've reached the pinnacle of fiscal stimulus. We can't spend more. We're going to have to, but everybody knows that's a key theme. What's one of the key themes in all the elections? Inflation. Part of the main reasons there's inflation, despite the lower end of the economy not doing so well, is all the wealth effect from the rich people making more money, that 10% of the wealthy people who own 80% of stocks. So I think it's a lose-lose in stock market. I think we reached the end game. My evidence for that is gold just going parabolic, crypto's collapsing. Just a matter of time, the whole thing implodes. And at least, here, put it this way, David, just a little 10% correction. The first thing people say, oh, it's healthy. And I think it's going to turn up like cryptos. To me, the whole thing's turning over. And I'm saying that with somewhat confidence because I've never seen what's happening in the precious metals, what's happened this year. Never seen that. Now I've seen, I took the risk of making that call that Bitcoin, when it was above 100,000, would drop to zero. I still stick with that call, but it's the sense I get of hubris and people way overweight long assets, and they're not used to losing money, and we're overdue to find the tide go out a little bit, unfortunately, and that's what precious metals are warning us.
When you say only a matter of time before the whole thing implodes, are you referring to all the asset classes that we've talked about so far, or are there some assets that will survive the storm?
So here's a simple thing that proved me wrong. Bitcoin staying above 100,000. Here's a simple thing to prove me right. 180-day volatility on the S&P 500, which is at 11%, about an 8-year low, simply going to its 10-year average around 17 or 18%. You see the simplicity of that statement that completely shocks me. That's how low we are. That's how you have to keep volatility low for an inordinate amount of time. You have to keep the stock market above 7,000. I pointed out that might be the peak for all these fun things to happen, for cryptos to recover, for crude oil to stay strong, for copper to stay strong, maybe above 6. And the normal situation at this point is volatility. Sorry, a quote I learned in the trading pits in 1991. Volatility has always been reverting. It's way too low. Just the simple little things. I think the smart people are loading up in cash and T-bonds.
What are some of the asset classes that you're most bullish on for the next month and a half?
I'm most bullish on U.S. Treasury T-bonds. I don't see anything else that's worthy of buying except for a trade. Now, Bitcoin at 64,000 was worthy of a trade. I don't trade anymore, but I just pointed out it's good support. Obviously, momentum in the stock market is going up, but the point is everybody knows it. Everybody gets it. They're all piled on too much. So next couple of weeks, I don't know, month, I don't know, but by the year end, I think we're going to be seeing at least some point the problems of markets have just gone too far, as indicated by gold going parabolic and cryptos breaking down. As far as main thing is, I don't give investment advice, but no one's ever said I can't say overweight U.S. Treasuries there, David, and that's why I'm really going to keep saying it, because this to me is a trade of a lifetime. And I did similar in 2007. It was way too early, and then of course 1999 is way too early, and that's part of the curse of being unable to nail some of those moments. You miss some of the big upticks in long-term and enduring rallies. But we're at that point now that any position I look at now, risk assets, you have to look over. Like if I'm sitting here watching my long position copper, which I used to, I have to be watching that S&P 500, and I better hope it's going up, because if it's not, I'm going to lose money in copper being long. It's almost, they're all together. They're all linked now. That's how we are. And we need a little flush. That's unique. That's one of the things I'm really appreciating about crypto. So at least we're getting that flush. The silliness from a year ago was like, oh, there's going to be pain. And I look at it as a father and a switch over a money manager. I don't want to see pain. It's my duty to warn people. So I am.
The fact that gold and silver have not yet retraced their 2012 lows, in the sense that they haven't fallen from their highs to the same extent that they did in 2011. And you did write in your report that gold is exhibiting the same kind of topping pattern that you saw in 2011. What does that signal to you? Are we expecting gold to fall another 40, 50% from current levels, which would make a total of 70% from its highs, which is what we saw in 2011, 2012, over a multi-year period? And same thing happened in 1980, by the way.
So, and the key peak initially was in 2008, and that only dropped 30%. And then 2011, that was the all-time high. But we are compared on many relative value measures. We're much more extreme when we were them. If you just look at price relative to many moving averages, people use it as standard deviation. It's always a measure over time. Standard is 60 months. You can even go out to 120 months or 10 years. We're more extreme than that period. That's my point. I didn't think that would happen. David, check mark wrong on that. But we're at the point now that it's the risk of being long these assets, gold or silver, platinum, palladium, almost all of them, metals at these levels, particularly silver, is almost the highest in 50 years from a new long standpoint. As far as how far it traces, the levels I'm putting on is I initially started with, I think gold gets back to 4,000 in a heartbeat. First of all, what can happen? Imagine we wake up in the morning, we find out there's détente, significant détente in the war in Ukraine. Poof, I can drop to 4,000 in a heartbeat. And silver, simplistically, normally, almost always the devil's metal, will cause pain. 50 is the first sign, I think, decent retracement support for pain.
The fact that the DXY traded inversely to gold and silver in the beginning of February may signal the fact that perhaps some of the selling forced capital to go into the U.S. dollar. Is that a fair statement to make, or have you noticed capital rotating into some other asset classes?
My sense from prominent, wealthy, smart U.S. investors is GMTFO. Get me the heck out. Find me alternatives. Gold's one. Emerging markets, overseas equities with their highly valued dollars and highly valued U.S. assets. That's just not equities. It's also real estate. It's harder to diversify. That's my sense, which makes sense. But as far as the dollar factor, the macro for the dollar, big pictures, yeah, it's expensive. It's overdone compared to the rest of the world. What you're going to use. You got gold, but it's already overpriced. You got stocks, they're overpriced. The key thing I like to point out is what's happening in cryptocurrencies. To me, the most enduring trend in all cryptocurrencies is forget all these silly tokens that most of them need to go zero. It's stable coins, crypto dollars, and Tether. I like to point out Tether right now is number 3. It was like 12 before. When I remember it was in Hong Kong in 2018, pointing out how important Tether was. It was 2 billion. Tether's going to flip in Ethereum. Tether's right now is about 184 billion. I think it's a matter of time it flips into Ethereum, which is if it gets down to 1500. And what's the trend there? Is the technology is awesome. It's all gone to dollars organically. So the whole world in the past to get away from the dollar, use your phone, you flip into Bitcoin or one of the other spin-offs. Now you got crypto dollars. Why? That whole use case for cryptos is turned away, but organically the world's gone from the dollar to crypto. So I'm looking at, yeah, you can call it de-dollarization all you want. There's significant war on. There's a reason for that war. Remember, these two major powers coalesced up to an unlimited friendship and attacked their best customer, or at least Chinese best customer, Europe's background. Let's remember that there's a war going on led by these, and you have to do the right thing. You can't just add fuel to it. So I think what's going to happen is the dollar is going to come out this much stronger than before. And you look at organically versus the rest of the world. The problem have always been the dollar is too much strength. Plasma Accord, I was in Europe at the time. I remember that one well. And just what's happening in cryptocurrencies organically means a lot of these other, certainly in South America and stuff, these peripheral currencies that melt, they can backstop with the dollar via stablecoins now.
Okay, so let's just take a look at my screen one more time. The S&P to gold ratio. It's trending down. Yeah, you talked about this several times in your report. What is a reasonable, I guess, historical trend reversal level for you?
1-to-1. So it's the ounces of gold that measure the S&P 500. And admittedly, this is not including total return. The key thing is total return of S&P 500 versus gold always goes up over time. But where we are right now stopped in 1997, which means since 1997, that stupid rock has been outperforming the whole ingenuity and human nature and everything of earnings of S&P 500. That's scary. But you see in that chart, that's a significant downturn. The first one started at, it shows 150, but actual high in 1929 was 154. That was September. And then you got that high in 70, 69, 70, 71. See that rollover there? That says the U.S. came off the gold standard. Then we had that big internet bubble, but the rollover looks like a perfect head and shoulders going back to 1-to-1. I'm afraid now, though, what drove that rollover was just gold taking alpha. What I think is going to drive the next leg is beta driving everything lower. Simple, just taking out. Let's start with this: a 10% correction S&P 500. Imagine that. That's almost 25% of GDP. It's almost the most in history. It's just so past expectation. That's part of, to me, what cryptos collapsing have figured out, what gold taking off is figured out. But now I see the only next final big trade is looking for the deflation. What happens in the stock market simply reverts a little bit.
I'd like to end on this note. So if you take a look at how this stupid rock is done in 2011, up until 2011, there was a 10-year period in which it outperformed a lot of things, like the S&P to gold chart did. And so my question is, Mike, during that period, did the rise in gold signal a fundamental shift in the economy or our society, such that people would flock to this stupid rock as opposed to stocks? And are you seeing a similar shift now? In other words, does it mean anything for the average person now that gold's at $5,000?
It does, but they're not going to get until it's too late, unfortunately. Now, like I pointed out, that's what I'm really fearful, because your average, I'm looking at CNBC, Bloomberg, and CNN on my screens. You don't see a lot of gold out there, but I see a lot of stock people pushing stocks and ETFs and things. And it's just the unfortunate part of human nature. It's not attractive from a sell side standpoint. What really pumped cryptos and put in the peak last year? Sell side selling ETFs. And they're way over, they're selling a lot. And they're finally kicking in the gold and precious metals ETFs. But this is just I think it's a classic beginning of a normal normal cycle shift in markets, and gold is signaling there's something wrong. So you see that little chart in S&P 500, simply it's rolling over. Yeah, it should bounce a little, but what really stops a normal rolling over towards an enduring mean around one? And then you look at U.S. stock market capped in GDP. Okay, it's the highest ever. Well, sorry, since 1928 on the way down, 1929, highest since Japan. Yeah, we can explain that way. And then we look at things like the stock market versus the Bloomberg Commodity Index. It's the lowest, not stock market, sorry, it's the highest in 25 years, and versus the rest of the world. Just last year was the highest ever, starting to roll over. So this make America great, a thing that is going to kick in. And then there's also the politics involved. That by this time next year, we're going to be saying Mr. Trump and lame duck in the same sentence. It's all tilting that way. Number one issue is inflation, and everything he's doing is inflationary, most notably pushing back on the Fed. It's sometimes a perfect trade stares you in the face. And first of all, you have to be wrong forever. And I was wrong and have been wrong and forever on T-bonds, but I was right in gold and right in Bitcoin for quite a while. Jumped off most of those horses now. And all I see now is the potential the stock market goes down. Now, if we end the year and it's up 10%, that would be awesome. But just imagine down 10%. It's starting to trickle down that could last for decades.
So that's my final question, Mike, is where do we go for yield? You mentioned you like bonds for the foreseeable future, for the next short term to medium term at least, but that implies perhaps yields are going down. And you're not too bullish on on Bitcoin. You're not feeling great about stocks. Gold may be exhibiting a topping pattern. So if I want yield, I want to just park my cash in some place that would generate yield. Where do I go?
U.S. Treasury long bonds yielding about 5%, TLTs yielding around 4.8%. There's that long bond future, US 1. I started in that trading pit, David, in 1988. It's right around 115. It's got really good support around 113. That's the support since 2007. I think the risk rewards, it pops to 140. And then we're all going to realize, it's the only issue. There's only one issue in everything is the stock market, U.S. stock market. It just got too expensive. So I look at the whole Treasury sector, not certainly a long bond, as basically a put on the on U.S. stock market. And that put actually gave you 7 or 8% last year. I think when the stock market drops 10 to 20%, it stays down a little bit, that put will give you 30%.
I appreciate your thoughts, Mike. This is a great chat, good follow-up, and good update. Tell us where we can find you.
On your show, David. Thanks for having me back. We'll see how things work out by next time. I'm on X at Mike McGlone 11 and LinkedIn, Senior Commodity Strategist at Bloomberg Intelligence. And I'm happy to put people on my distribution list.
Okay, and I appreciate Mike's insights. Please do follow Mike on X. He posts some great updates and analysis there regularly. So when he's not on my show, follow him on his social media. Thanks for coming back, Mike. We'll see you next time. See you soon.
Thank you, David.
Thank you for watching. Don't forget to like, subscribe.